Thank you, and thanks for everybody for coming to the summit today. Thanks to the organizers and everybody else. This has been great. We are going to dive in and talk stablecoins. You've been listening to a lot today. We're going to give you some more. Want to let everybody give a round of introductions. Name, where you are, and maybe just like a quick 1-2 sentence overview of what you do.
Yeah, I'm happy to start. My name's Irene. I'm head of strategy at Layer Zero Labs. Layer Zero Labs is the primary developer contributor to Layer Zero, which is the leading omni-chain interoperability protocol, and also Stargate Finance, which is the most widely used native bridge. We're also the creator of the omni-chain fungible token standard and are involved in a lot of novel stablecoin projects, which I'm excited to talk about.
Hi, I'm Smita Purohit. I'm a product manager at PayPal in their crypto business unit. I lead essentially the Web3 strategy for PayPal and Venmo, and we're looking at what are the key use cases that our new stablecoin, PayUSD, could enable.
Awesome. Hi, I'm Isha Vashne. I'm head of ecosystem strategy at Salo Foundation. For those that are unfamiliar, Salo is a layer 1. We're transitioning to an Ethereum layer 2. What makes us super special and unique, in my opinion, is that we're very mobile focused and we are mission focused on our mission's prosperity for all, and we focus on emerging market use cases that include financial inclusion, climate, and community. Essentially, we have an ecosystem where we are building for real world use cases, and stablecoins is a really, really big use case for us because essentially my ecosystem is the everyday person in Africa, Latin America, Southeast Asia. So I'm really excited to be talking on this panel.
Great, thank you. Matthew Commons, president of the Verified USD Foundation. I'm really happy Irene from Layer Zero went first. She mentioned already Layer Zero's omni-chain fungible token standard. So we are the first stablecoin to use that standard. And also are using another Layer Zero technology called Color Trace, which allows us to track which entity brought new capital into the system and to be able to share the yield with the various different minting partners there. So really looking forward to today's discussion. Thank you.
Hi everyone, I'm Thomas Matamore. I lead ABC Labs, which is it stands for asset-backed currency. We work on the Reserve Protocol, which is a protocol with a mission to expand access to stable currency and fight inflation around the world. We went live around exactly 1 year ago, and we went up to 40 million in TVL over the last year. We allow anyone it's a platform that allows anyone to launch a stablecoin, which can be backed by a bundle of tokenized assets. And so that can be a stablecoin, it can be a yield-bearing stablecoin, it could even look like a diversified ETH staking basket. So yeah, very excited to be here with everyone today.
And I am your moderator. My name is Matt. I run business development and governance at Gauntlet. Gauntlet is a quant firm focusing on optimization for DeFi protocols, risk management, incentive optimization, some forward-looking research as well. But glad to have everybody here today. Appreciate everybody taking the time. Let's just dive right in. So, I think we have a pretty diverse panel. Some work directly with stablecoins. Some are attracting stablecoins to their chain. Some are bridging stablecoins. Would love to hear from you guys, like what are some of the newer use cases that you're seeing come out? And like, what are some of the newer designs you're seeing? Because I think we all know, like what the traditional designs and use cases have been. Like, what should we be on the lookout for? Let's start with Irene and we'll take it on down.
Yeah, I feel very lucky that as someone on the Layer Zero Labs team, we meet a lot of projects that are launching new tokens. And one idea that really resonated with me, which eventually led to the advent of USDV, was the idea that there are a few teams which have created stablecoins which have a large monopoly over this kind of asset. And many of the protocols that have played an integral role in proliferating or growing the usage of these stablecoins don't ever capture that value back to their community or their protocols. Meaning, if you're a PancakeSwap and you are the primary gateway in and out of the BNB chain ecosystem, what value have you captured back from some of the major US dollar stablecoins? Now with other stablecoin designs, USDV being one, using a novel algorithm our team created called Color Trace, but then also I have friends who are working on other yield-bearing stablecoins. you can create avenues through which you can issue that value back to your users. It is truly democratic in that way, and also I think begins to, again, divorce the idea that there's one central entity that captures all of the revenue or all of the value from something that many users drive the adoption of.
So PayPal was the company that took payments from offline to online. And we did that 20 years ago. And with the launch of our stablecoin PayUSD, we think that we have an opportunity to take now payments from online to on-chain. So the kind of use cases we see, I would broadly put that in two kind of categories, right? One is where the user is directly interacting with PayUSD, and here the user, I mean merchants and consumers, and these are your day-to-day use cases, right? Which is, how do you make sure we can pay a merchant at checkout? How do you enable merchant settlement, vendor payments, like venture funding? So these are the day-to-day use cases that I think PayUSD can make faster, better, cheaper. But there's this other kind of use case, which is basically the payment rails, which is agnostic to what the user uses on top, but essentially solves big problems like treasury pre-funding and things that people don't understand of how complex payment systems are. And I think PayUSD can kind of help both categories of use cases.
Yeah, thank you for that. I think my perspective is a little bit different. I sit at an ecosystem because we're emerging market focused. Our focus is essentially to get a dollar denominated or stable currency denominated stablecoin in the hands of everyday users that are in certain markets that have extremely deflationary pressures on their domestic currencies, right? And so what I'm really excited about is like getting these people access to whatever stablecoin that is. And as Irene mentioned, like there is now becoming transfer of not only just the dollar denominated stablecoin, but also transfer of value that is linked to the stablecoin. So when I look at my ecosystem, what does my ecosystem want to use the stablecoin for? It's really important to kind of define that. My ecosystem wants to use the stablecoin to like hold money in a dollar-denominated currency or a euro-denominated currency, maybe generate yield on that. So that's in my mind excellent use case. But then on the other hand, when you think about like, okay, we also want to borrow, right? And so if you're borrowing in a dollar-denominated stablecoin, that gets really expensive because if you are in a country, for instance, Nigeria, that has 40% deflation in like 5 weeks, you not only take the loan out in a dollar-denominated stablecoin and then like have to not pay only interest, but also have to pay that FX spread, right? I think what we're, at least from where I sit, what's exciting is A, transfer value, like Irene mentioned, but also like domestic currency stablecoins, right? And so we have Mentor Protocol in our ecosystem that's doing some of this. Mentor Protocol has a couple of stablecoins that are emerging market focused. So they have something called the CREAL, they have a West African franc, and so they're actually working on like mechanisms where they have something called the stablecoin factory, which they're working on, which is like backed by USDC and some of the other stablecoins, as well as like Bitcoin and ETH. But what they can, the ability to kind of then mint native stablecoins in local jurisdictions for like private credit or those kind of use cases is also, in my opinion, really interesting in the near future.
Yeah, so for verified USD, the use cases where we're starting are really more of the conventional stablecoin use cases around CeFi and DeFi, starting especially on swaps, farming, getting into borrowing and lending, things like that. But definitely longer term on our roadmap is really using this in the real world, and I think a lot of the emerging market use cases are quite interesting there. And when you look at some of the differentiating factors and just the basic principle of being able to share yield with the partners that are bringing capital and users and others into the system, that's something that certainly works for CeFi and DeFi, but it's also something that, if we have a partner in Vietnam or a payment gateway in another part of the world or what have you, they certainly have an interest in bringing new users in and sharing in the rewards of that as well. So it's something that the technical design, I think, transcends a number of different use cases. But yeah, very eager to look at the real world things over time. So thank you.
If I can just add one quick thing here. I think what's doubly important in sharing value or revenue sharing back with your users and protocols is that it's verifiable on chain. If it's once again through some off-chain centralized entity, It's similar to your credit card company giving you points or rewards for something, just trusting that they will. And the novelty of creating algorithms in which you can enforce these within smart contracts is what I'm excited to see from new stablecoin issuers.
I couldn't agree more with like everything that you all just said. I'm a big proponent of on-chain transparency of how collateral is used to back a stablecoin, as well as I think some of the other things that we're seeing that are really interesting is people are starting to realize that there's a lot of yield behind stablecoins. There's actually been talks for the last 6 hours about how there's a lot of yield that can be shared in different ways. Yours was awesome. Today I learned about color tracing. That's like a really cool way to give attribution in a way that wasn't really possible before to a decentralized stablecoin that is having different partners mint it and drive value to the ecosystem in different ways. Some of the other features that I've seen that are interesting in the stablecoin space is, like in general, there's the decentralization aspect of the management and the minting and the issuance, as well as the management of what backs it. That's like one big bucket. Another big bucket is the safety of the backing, right? Is it a over-collateralized crypto asset, right? Like DAI, famously, for the last 5-7 years now, has been doing and building. They've run into issues with like how scalable is that in the long term, which is an interesting aspect behind what you do back it with. Treasuries, fortunately, are like infinitely scalable in crypto terms, which is pretty exciting. The other big feature that everyone's been touching on, but generally, is how is this yield shared and distributed? Is it sent to companies that are helping growing it, like the color tracing? Is it sent to a over-collateralization pool, like happens sometimes on our protocol with a couple of our different stablecoins? It can also go to liquidity incentives to help promote further usage of the ecosystem. And so the magic of like programmable money and smart contracts and this whole DeFi thing that I'm pretty sure everyone in this room is already convinced on, is that can all be done transparently, like you're saying, and it can be done on-chain, and it can go in an infinite different number of places, right? There's obviously like a limit on how much yield is there to share, but when it's not all going to a single company, but it's being shared between a pool of different groups, there's a whole bunch of different things that yield can go to incentivize.
If I can add one more thing there, you're making me think about the differences in issuing yield directly to users or to projects and the KYC implications of this as well, or security implications of this. And there are many novel stablecoin issuers who are running into this now and wondering, how can we make this more friendly so that DeFi native lending and borrowing protocols can actually feel comfortable listing it? Gauntlet team, I'm sure, has advised many in thinking through this. And so when I'm meeting new stablecoin providers, I'm always wondering, like, from a regulatory perspective, is there something novel that you guys have created in the revenue sharing mechanism?
Gauntlet gives regulatory risk assessment for protocols?
We definitely do not. But thank you all for the answers. I think
a little color, maybe. A little color and perspective.
Yeah. No, appreciate the responses. Hearing a couple themes that I'd like to touch on. I mean, one is emerging markets. I think it's easy for us, especially for us based in the U.S., like not to really see what's going on in other parts of the world unless you're out there or really paying attention to it. Would love to hear. Maybe Matthew, we'll start with you and we can move through. But like, what are the use cases that you're seeing in emerging markets? And are there other use cases that you think will emerge over time?
Yeah, I'd say for USDV, it's somewhat exploratory, but it's very much an active exploration. I think there's different classes. I mean, emerging markets are not all the same, but there are ones that are particularly interesting. The high inflation use cases. I saw actually one of the attendees we have here is someone from the city government of Buenos Aires. So I was just down there a few weeks ago, and really amazing to see the potential here. I mean, this is an economy that, the Argentine economy holds 10% of the physical U.S. currency in existence. This is, people buy houses with stacks of $100 bills. People do not trust the banks. They do not trust the government. They, store money under the couch and different things. And you have, some pretty strong adoption of other stablecoins. I think Tether on Tron is probably the biggest one down there. But just seeing how that is today, seeing how, okay, if we partnered in some way that could share the yield, who would we partner with? How would that work? What are the regulatory implications? Things like that. Very, very interesting. Other economies, Vietnam, we have a partnership with Viction, which is a Southeast Asian-focused EVM blockchain. So, looking at a variety of things there for really more underbanked sectors. There's others, we'll be going to Mexico next week, looking at huge remittance flows that you have going through crypto. Many billions of dollars per year that are going through crypto. Just in basic remittance rails. So actually we'll be meeting with some of the reserve team down there, so looking forward to that as well. So yeah, again, exploratory at this phase, but looking forward to learning from others, especially Cello as well. I know this has been kind of your bread and butter. So yeah, excited about that.
Yeah, I think maybe I can talk more about some of the use cases that we see at Cello Foundation. Our focus has always been emerging market, right? And so I'm going to give you an example of something that we just launched recently, which is a partnership with Opera, which is a browser product. The interesting thing about this browser, it comes pre-installed in every Android device, and for most of us, like buying an iPhone is easy, but in some of these markets, like a $50 phone is what they use, right? And so having the ability to access, download an app is not sometimes a reality in some situations. And so this partnership with Opera, there's a browser that's already pre-installed on your phone, and we've added a wallet functionality to it. And what it allows, and it's a stablecoin only wallet, right? And what we're seeing is we launched this in September, and we've only launched in Nigeria, Kenya, and Ghana. And there's 1.7 million users on this wallet today, right? And so there's clearly an appetite for stablecoin users in some of these markets, right? And so what are they doing with this stablecoin, right? They're doing simple things, peer-to-peer transactions, right? Learn to earn. They're doing savings, and like we've talked about, transfer of yield to this. And so there's all of this, but there's so much potential. You'd be amazed about peer-to-peer cross-border remittance that happens, right? Billions of dollars go, the number, if you look it up, I don't want to say it here, but the number that you look up just for cross-border remittance from a peer-to-peer perspective that goes into Africa on a yearly basis will blow your mind, right? And so just peer-to-peer remittance and a dollar-denominated stable is game-changing for some families over there, and some for ecosystems over there. And then clearly there's the B2B use cases, right? So if you are in a business in one of these emerging economies, maybe your suppliers or vendors, et cetera, don't want to be paid in a Naira, for instance, right? If you're supplying something to a vendor in Nigeria, you don't want to be paid in Naira. So there's clearly this B2B. And yeah, and then you can kind of build on top of that. You can do savings, you can do remittances, you can do lending. The world is your oyster after that.
Yeah, you bring up something that's really interesting that I think I'd like some of your perspectives on, primarily Thomas and Smitha, just given kind of where you sit here, is do most of these people know that they're using stablecoins? Are they using white label solutions? What does that look like for somebody on the other side of the world?
I don't think they necessarily always know, but they definitely don't care. Has been our experience. Yeah. For context, our sister company actually has an app in Latin America that operated for the last 5 years. There was around 600,000 folks in Venezuela that were using the stablecoin on our platform for everyday usage. And they could actually pay at the store. They could get paid by their company. I think Burger King, the Uber equivalent in Venezuela. There was a whole group of people. And everyone just wanted to hold dollars. They didn't care what the ticker was on that. They just wanted it to be dollar denominated. And I think that's at the end of the day, stable coins have by far the most product market fit of anything in crypto, just because people want dollars and they can't get access to them. In Colombia, it's illegal to hold dollars in a bank account. In a variety of different Latin American countries, there's limits on how many you can hold. And so, yeah, at the end of the day, let alone a savings account with yield, or heaven forbid, FDIC insurance. People just want a dollar-denominated thing, right? And so if you can add those different types of features on top of a stablecoin or a financial platform and give people access to it, it's a total game changer, in my opinion. Once it's actually in their hands and there's a good experience and you're not using a ledger to pay at the grocery store.
Yeah, I just also maybe just quickly want to add, aid remittance is such a great use case. Aid currently is super opaque. And so to be able to imagine a refugee camp, if you're donating to a refugee camp in one of these countries, you can kind of see an on-chain transaction that's going from your dollar wallet to their dollar wallet immediately. They don't care what stablecoin they're getting as long as they get that remittance, right?
I think, for PayPal, like I mentioned, right, there's two kind of primarily broad use cases, right? One is where users directly interact with them, which I completely agree with, like all of your points, right? There's this other thing where people don't realize that the payment rails today are really, really slow, right? I mean, if you look at in domestic settling, it takes several days. Cross-border international is like up to 7 days, right? And but today, when you send your sister $100, your sister gets that in 30 minutes. So the last decade has been spent on improving the user experience while on really bad rails. And the way that happens is that companies pre-fund each other so that you can have that kind of experience where you can get the money, and it gives the user the illusion that your money moves that fast. But in reality, it doesn't. And so actually at PayPal, I think it doesn't matter, because no matter what your user wants, we can either fix the rails or you can hold it yourself, right? So I think that is super exciting. And the cost of capital when you have these kind of pre-funding contracts is humongous. And at PayPal scale, which is like 200 countries, 35 million merchants, 400 million consumers, like it adds up.
If I can lend a perspective on where fragmentation comes into this, when I was in Istanbul for DevConnect, I was paying for a service, I guess I'll say, like a security detail, and they told me I will accept USDC on Solana. So again, they didn't say pay me in stable coins. Like the concept of stable coins, when we talk about it like a subset of general ERC20 tokens, is not something that takes up mind space. It's just value. For me then, and I spend my days thinking about interoperability, I had to go, it was like 1 a.m. and bridge USDC from Ethereum to Solana. And it took me many hours, some tears were shed. I ended up calling a friend and did a really janky OTC swap, and I was like, here's my wallet address, you just send this here. It was incredibly embarrassing for the entire state of interoperability. And when you think then about a world in which there are people who have stablecoins that have US dollar exposure, they're from different countries, and now they want to exchange with each other, because we are in a global economy right now. But some of the stablecoins are USDT on Tron, and then some are USDC on, let's say, like Optimism. And then you also have PayPal USD, and you have Curve USD, and all of these on different chains. And now you're looking at your wallet and you settle to do like a janky OTC swap. The user experience is horrible, and then also the chances that there will be scams and fraud become much higher. And this then is, a huge inspiration for me and the team at Layer Zero to think about how we can enable horizontal composability. So just transferring, not bridging, mint and burn, seamless one-click, one gas token from one L2 to another L2, have there be transparency as to where your token is at any given time, and to have these be one-click within wallets. Or, Beam Wallet by Eco is a great example of this. It's a very clean, abstracted user experience. They have USDV in the wallet too, and it's just meant for stablecoins. This aspect of stablecoins being used in the real world matters a lot to me, and the fact again that I was distraught at 3 a.m. in Istanbul, and we are of a very privileged set of people who are DeFi native, is astonishing.
One thing you were touching on is, people don't care necessarily which stablecoin it is, as long as it's a store of value. And I think that that's especially true. It's especially important, the safety aspect, for people that are using these things as money every day. If someone wants to use a stablecoin or has a fintech app that is their primary banking-like experience, they can't be, they can't need to scroll Twitter every day and know, like, is the peg stable, or is there like a change in the markets that's going to change this? It has to just work, right? Like, that it's a massively important thing for a stablecoin that is used for payments, that is used for everyday savings, that isn't a leveraged vehicle within DeFi, for it to be like really safely backed, right? And maybe that's dollars in a bank account somewhere, wrapped around like 4 different types of software, all these different smart contracts. But the real critical importance is that it's really safe for the user and that they don't have to think about it ever.
when you're launching a new stablecoin, I often think you're actually selling the idea of trust. And so the teams that have done a really, really good job of this are ones who, signal through, yes, consistency, but also through their availability, the on-ramps and off-ramps, that they are an entity and an issuer that can be trusted. So, narratives actually play a really important role in getting new stablecoins off the ground as well.
Actually, I couldn't agree more. Like, especially, like you said, on the payments use case, like if we cannot, if our users, like the consumers, the merchants, cannot trust that they can redeem their stablecoin 1:1 with extremely low or zero fees on a platform that they trust, like this will not work.
I also just want to maybe double click on something what Irene said. It's about on and off ramps too, right? You have to be able to trust that, like, if I have a dollar in my wallet, in my stablecoin dollar denominated stablecoin in my wallet, I want to go to like whatever my domestic currency is, Naira, Kenya shilling, whatever the peso. I can do that, and it will come to my fiat immediately with not massive spreads, right? Because if there was massive spreads, then it becomes like the banking network, right? So just having a stablecoin like you guys mentioned, which is backed by something that is trustable, and like I know, yeah, okay, this will not depeg tomorrow, is also is really, really important because nobody's checking it other than some of us here. But also, like, I also have to be able to trust that, like, I can get this into fiat immediately, and like that piece of the puzzle works.
Yeah, well, just this whole idea of, okay, can I get it back into fiat? How is this going to change? I mean, it has a lot of echoes of, actually like pre-Civil War, when there were basically wildcat banks with notes. This is before the formation of the OCC, and you would have bank notes for a bank, and if it was like in the town, they would probably trade pretty close to par. If it was from some bank in like a territory that's not even a state yet, it would be a bigger gap. And there were actually like broadsheets in New York that would just list these different banknotes and whether they were trading at par or a discount. And generally, the further they were from New York, the bigger the discount is. So a lot of it is about information flow. Are you comfortable with that? Do you know what's behind that? And then can you actually trade? Is there liquidity? The best is direct fiat on ramp and off ramp. Circle has done a very good job with that. But even if you can trade, do you have the information to know that I'm going to be able to get out of this at something very, very close to par?
What's pretty interesting is that the on-ramps are almost more important for non-dollars. Because we've all been talking about how stablecoins are mostly important or mostly valuable to people outside of the U.S. But in order to use that stablecoin day to day, it needs to be converted to local currency somehow. And so I think there's a lot of interesting things happening in the space where people are getting creative with different types of off-ramps. One of the things that the fintech app in Latin America on the reserve side did 4 or 5 years ago is they actually built a P2P plaid type integration with local banks. And you could go from EUSD, which is a stablecoin on our platform, to Venezuelan bolivars, which is a massively hyperinflationary currency for those that aren't aware. Although in a stablecoin room, I imagine everyone is aware. One of the things, though, that we were really worried about, that the team at the time was kind of terrified about, was can you make markets between dollars and bolivar in a market that's hyperinflationary? And the interesting thing is that actually, yes, you can, because there's tons of businesses that need to pay back business loans. And so there's actually plenty of demand that like totally outweighs the retail influx, which is kind of interesting. And the other new type of thing that we're starting to see, mostly it's taken off in Europe, and we're starting to see it in Latin America as well, is debit cards and credit cards that you can actually settle with a stablecoin. And so like MasterCard and Visa have done this incredible job of building a network around the world. Anyone in the world except one of those two things, basically, right? And all the stablecoin really needs to do to get plugged into that entire network of every bodega, every grocery store, every wherever, is actually just settle with the debit card or settle the bill at the end of the month with the credit card. And so, I think that those are like two of the really exciting things that are happening in the adoption off-ramp space.
I'm just going to add to that. I'm actually seeing a lot of like off-ramp into there's fiat, yes, but there's also like really interesting solutions where you can off-ramp into mobile money, you can off-ramp into phone minutes, you can off-ramp into like some really interesting things that people actually need and like use in some countries more than they use their fiat currency. And so like, I think this space is so interesting and it's constantly evolving, and I'm excited to like sit here next year and see what people are off-ramping into.
I think one of the other things that's kind of required for this is like meaningful products that can bring the two sides of the ecosystem at scale, right? Like for instance, we need meaningful products for consumers, meaningful products for merchants. Like if you want to do merchant payments at scale, you need the ability to have send an invoice, get accounts payable, accounts receivable, right? And so that ecosystem needs to be created so that there's a network effect. And then there's a flywheel that's generated out of that, right? So I think that's why I think it's proud to be part of PayPal. Right? We're trying to build those kind of things for both sides of the ecosystem.
Yeah, I think super interesting, and there's a lot to be excited about based on a lot of what you guys are saying. One thing that I heard in various flavors among your responses was safety, trust, collateral. For those of you who know me, you know we spend basically all of our time thinking about market risk. We work with money markets who want to list stable coins. We spend a lot of time analyzing the collateral backing these stable coins to understand, is this safe? We're starting to see the emergence of new types of collateral for stable coins, things like liquid staking tokens and otherwise. Curious to get some of your takes on, how do you view different collateral types that are behind these stable coins, and how do you view like managing that over time? Because a safe collateral today may not be a safe collateral tomorrow. Thomas, start with you.
I can talk about this one all day, so I'm going to try to keep this concise. But quick bit of background is the way that our platform works is you can governance for each individual stablecoin on our platform is also an over-collateralization pool. And so they choose what goes in the basket backing a stablecoin, and then they're paid for their efforts with a portion of the yield from the underlying collateral. And what's really interesting is we've seen a couple different types of stablecoins on our platform go for very different types of assets, right? And so there's a broad range of collateral assets that can back a stablecoin that have been tokenized, right? You can have the over-collateralized DAI version. You can have the treasuries in a bank account that don't share any of the yield, like a fiat-backed stablecoin, right? Like PyUSD or USDC or any of those. And then there's all these different DeFi dollar-type derivatives. That are, the Aave and compound lending markets, all of these different things are, at the end of the day, very similar to what happens in a money market account at a bank. They're not exactly the same thing, no one should say that because they come with very different types of risks. But if they look from the outside like a similar type of product, and so I think in terms of managing that risk, it's a really hard thing, especially for governors of particular protocols to do in a very effective, data-intensive manner. And so, actually, thank you very much, Gauntlet, for managing all of the risk for many of the DeFi protocols in the space. But it's something that each protocol is going to have to really figure out how they can get a service provider to do this type of analysis and hopefully standardize it in a way that it isn't like super expensive, that it keeps out the upstart, experiments and test type protocols.
Yeah, I think we're at the Verified USD Foundation. We're quite interested in exploring this as well. Right now, we have one collateral token, which is issued by an affiliate of Matrixport. It's called the Short-Term Treasury Bill Token. It is fully short-term treasury bills pegged to $1. It rebases every day, even on weekends. And I think when we're looking at the future, we do anticipate having other similarly structured backing. So, 100% short-term treasury bills, rebases every day, pegged to $1, and so forth. So, eager to explore that, and probably we should talk to Gauntlet about some of the funds you're advising, because maybe a good fit there. So, thanks.
You know where to find me. Isha, you probably have a different perspective on this, given Celo. As you think about bringing more stable coins onto Celo and the adoption, like how do you guys think about collateral in that regard?
Yeah, I think I sit in a really interesting place. I think my ecosystem, like I mentioned, is real world everyday users. But there's also like crypto native use, like crypto native, like retail, well, retail, institutional, whatever. There's like two separate segments in my ecosystem, right? And so the way we see it at a network perspective is like we actually want to be the home of stablecoins because I think because we're really emerging market focus and stablecoins have like excellent like product market fit in stablecoins. And so my hope and aim is that like by the end of the year, you can say Salo is like home for stablecoins, whatever type, flavor of stablecoin, whatever you're backed by. And like from our perspective, there's a user for every different type of stablecoin, right? Because like if you are backed with something more exotic, like an LST token or something like that, well, the risk profile of that kind of increases, right? But you also that also kind of is subset by the yield opportunity for that specific stablecoin. And so from an ecosystem perspective, we're agnostic to like if you are okay with absorbing this risk, yeah, you should definitely be able to have that return too, right? Yeah, and so like a stablecoin is a stablecoin, and so providing access to that is really important for where I sit. And then like it's the user's perspective of like, what do you want to? And like I imagine some of this getting really interesting, right? In my mind, like 6 months from now, it'll be like I on-ramp from X stablecoin and then go into Y stablecoin because that has better yield, and then go back to X because that's like better on-ramping or off-ramping facilities, right? So I think there's a lot of like the space to play, and I think like this is just tip of the iceberg. I think we'll see a lot of interesting things come out in the next few months.
There's like there's so many different consumer experiences that can be built on top of DeFi that work the same way, right? You can have like a savings account and a checking account, right? You have your yield-bearing chunk of value, and you have your payments everyday chunk of value. And the way that it's displayed to the user, the way that it's surfaced, and in the different products, at the end of the day, like the different financial products that are encompassing both of those use cases for users is going to be something that evolves. And I'm excited for people to continue to build great experiences on top of it. I'm going to be like a broken record for everyone else at this entire ETH Denver conference and saying we need better UX. But yes, we do need better UX.
I think from PayPal's perspective, so we are a regulated entity, and if you want to have a stablecoin for payments, that trust of being able to convert 1:1 at any point in time is important. And so we work with Paxos, who's also regulated by the New York DFS, and they are our issuer of PayUSD. And from a collateral standpoint, like it was very important that it's like highly liquid assets, right? And so that was literally the only option that we had. Yeah.
Irene, I want to slightly adjust the question for you, given where you sit. We talked about bridging, we talked about in and out. Some of these stablecoins are using bridged collateral that obviously changes the risk profile quite a bit. What are your general thoughts on that, and maybe like how is Layer 0 kind of enabling more of that?
Yeah, when Layer 0 was first created, this was a couple years ago, and what was really cutting edge were wrapped asset bridges, which are essentially smart contracts which lock value of the token that you're trying to send and mints a synthetic version. It's like a coupon or an IOU saying this represents one version of USDC, and when you cross back across, hope that we'll give it to you and that there won't be some sort of exploit. What we've seen over the last 2 years is that many of these wrapped asset bridges have experienced exploits. More than $1 billion was lost in value in 2022 due to this kind of hack. So when we were creating Layer 0, what we found was much more interesting than this kind of model is the messaging layer below building bridges. Stargate V0 at the time was a native asset bridge. It is today. It is the most popular way to securely and quickly transfer or swap native assets from one chain to another. Layer 0 is just messaging. It's arbitrary data that you're passing from a smart contract on chain A to chain B. And stablecoins were actually one of the original use cases we had in mind, meaning if you're moving USDC from Optimism to Arbitrum, you probably don't want to wait the 7-day bridgeback period. You have a reason why you're transacting it and you need it on a different chain. So you first want that horizontal composability. You want to click, pay in one gas token and have USDC from Optimism now on Arbitrum. But on top of that, you also want to have the safety and peace of mind to know where your asset is. It's not being custodied by some third party. There isn't some team that might have venture funding, might have a Slack connect with you, and is securing it in their smart contract, hope that they don't make any upgrades to the contract. You want to rest easy at night knowing that you own it. That smart contract risk is ephemeral for the moment of that transaction. So we created this standard called the OFT. It stands for Omnichain Fungible Token. And the way it works is for any ERC20 token, you can now leverage layer 0 to manage the state across different chains, meaning if you want to move USDC from one chain to another, you're minting on this one chain. Well, you're burning on one chain and then minting on the other, maintaining unified supply and liquidity. So now, rather than needing external market makers and pools of liquidity to swap, you actually are just maintaining one-to-one across different chains. And more importantly than this, Layer 0 is a protocol. Layer 0 Labs created it, but we did not set out to create a service. A service is a product that requires the creator company to be alive, to have funding to maintain the integrity of that infrastructure. That would mean that you always need there to be 100 people in the Layer 0 office in Vancouver, Canada, to ensure that these stablecoins that leverage the protocol are securely passing across these different chains. It's an immutable protocol, and it's something that ensures end stablecoin issuers can own their smart contracts always. There's no fee or tax that they're paying to Layer 0. It's just like TCP/IP, and in perpetuity you can leverage this and have your users transfer from chain to chain.
Thank you. We are just at about time, so I want to give everybody just a chance, if you have any kind of brief final thoughts, and then where can people find you, people find what you're working on?
Sorry, get the phone call. Yeah, so thanks everyone for hearing, listening to everything about how we think about features of different stablecoins and all of that. If anyone wants to find me and talk and learn more about the Reserve protocol and what we're working on at ABC Labs, would love to connect. You can find me on Telegram or Twitter or Warpcast rather, at Mattermost, which is my last name, but like a little bit more.
Great. You can find us at usdv.money, and we'll have a booth at in the DeFi section at ETH Denver, and I think Irene and I also have a fireside chat on Saturday morning as well on the CMAT stage. So, thanks.
Similarly, we have you can find the Solo team. There's a booth at ETH Denver. It's right next to Circle, so clearly stablecoins are a theme. And then, yeah, I mean, you can find the Solo team at solo.org, or we're Solo on Twitter. Yeah, or come and find me here after.
So you can find PayPal. I mean, you can find us everywhere. But here at ETH Denver, we have a huge team. So come talk to us. We'd love to hear from you what you would want in your ideal stablecoin. So we're here to learn and listen. So please come find us.
We will actually be co-hosting an event with PayPal tomorrow evening. So there's a happy hour, and we've tweeted the registration link, so you can find us there. And if any of you are exploring novel stablecoin designs, something exotic and for degens only, or something for real-world merchant use cases, I want to hear about it. I'd love to jam on ideas. You can find me on Twitter at IreneWu27. Thank you.
Amazing. Thank you all for joining, and thanks again for having us.
Thanks, Matt.
Thank you.
Thanks, Matt.